Okay, I am stoked for today's main topic. This is a study that is not only near and dear to my heart, but something that I consider incredibly valuable. So much so, I got to start with a disclaimer. The results of my study are not intended to be utilized as a direct translation to your retirement portfolio decision making, nor is it meant to be directly translated to your retirement withdrawal strategy. What I have here only directly applies to the assumptions of the study within a box. And we create studies like this as people who are really nerdy about finances so that we can better understand reality and take the results of stuff like this in conjunction with our knowledge of the world that we've gained from other educational resources and make decisions in investing in retirement and withdrawal strategies with full confidence and understanding. So, in short, this is an educational tool that's here to help inform you, to help educate you so that you can be more confident in your decision making and understand it better, not as something that you can take with and run away as financial advice. None of what I say here constitutes financial or investment advice. With that out of the way, let's cover some of the assumptions in the study. If the results only apply to the study itself, we have to fully understand the assumptions there within. The first assumption is more or less the structuring of how I ran the numbers, and that was with monthly withdrawals, not twice a month, not once a year, not twice a year, once a month. I assumed 3% for inflation anywhere I had to take inflation into account. I utilized the concept of financial guardrails. You can think of financial guardrails as bumpers on a bowling alley, where if your ball, or let's say the bowling ball represents your net worth in your nest egg. If it ends up going too low, off down to the right side, and it hits the bumper, it hits the guardrail, you default to a more conservative withdrawal strategy if the ball drops that way. That helps your nest egg bounce back up into a healthy range where you can maintain your otherwise default withdrawal. Meanwhile, the bumper on the other side helps you increase your efficiency when it comes to spending. I have a financial guardrail that I think is very high, very conservative. If you were to take your nest egg at the start of your retirement and grow that value at a rate of 12% before taking inflation into account, well, that makes the upper bound. And in the study, I said, if your nest egg ever bumps above that line, well, you can start taking out 8% as opposed to whatever your default withdrawal rate was. And in the study, for the bottom guardrail, I assumed that a safe withdrawal rate of 3% was going to be conservative enough to help us get the nest egg value to bounce back up before we cross over the event horizon and the nest egg trends to zero before retirement is over. Next thing you need to know is I used a method known as the Monte Carlo simulation in order to run my modeled study. What the Monte Carlo method does is it takes the standard deviation and average growth from a given portfolio and then creates a bell curve, a statistical bell curve out of it, and randomizes what's going to happen next from a day-to-day basis. And in the case of the study, it was actually a month-to-month basis. I didn't get to the granularity of once a day. I modeled the Monte Carlo change once a month. If you're taking money out once a month, I don't care about the movement in between withdrawals. So the Monte Carlo simulation will randomly change what the next month is going to be so that the randomized selections it makes will make the bell curve skewed with the average growth for what you're putting in. Now, this begs the question, where do you get the standard deviation and the average growth? Well, you have to look at historical data in order to do that. And as you may know, if you've been focusing on personal finance for a while, historical data is not a guarantee of future returns. And you can't just look at historical data and say the market's going to do the same thing in the future. And that's kind of what the Monte Carlo simulation is supposed to take into account. We're supposed to say, imagine a portfolio that kind of does the same amount of volatility, the same amount of wiggles as it has done historically or in recent history, but also continues to grow at a rate that is arguably conservative, but historically backed. And because of the randomizations, you're supposed to be able to capture the unlikely scenarios that are not predictable from just looking at historical data. The historical data that I use to find standard deviations and average growths go back to right around 1990. I didn't have the same age for all different portfolios. I think the year that I actually started with was 1987 for the bulk of the data. But there were other funds that I personally have in my 401k that aren't quite that old, and I wanted to see what those results were. The most important thing in this study is I included the black swan events that hit. We're talking about the dot-com bubble. We're talking about 2008. We're talking about the Great Recession. Those big events that some people might ignore for a study like this and say, well, those are the outliers. Well, I wanted to include those in the standard deviation so that my Monte Carlo simulated data could include black swan events like those. Here's a huge assumption that I made in my study. I assumed that you were going to, if you had a stock bond mix, for example, maintain consistent monthly balancing of your portfolio. Let's say that you have a financial advisor, for example, who says, I want you to have 30% bonds and 70% stocks, and that's what I advise you to do. Well, I made the assumption here that through either withdrawing or moving money from bonds to stocks and stocks to bonds, you maintain that 30-70 ratio perfectly throughout your retirement. Now back to the simulation. Because we're working with a bell curve on the Monte Carlo simulation, I took the outside 5%, the best 5% of the data, and the worst 5% of the data, and basically said, these are the least likely scenarios. The odds that the stock market is going to be in the best 5% of a Monte Carlo simulation is unlikely, so we can't take the tippy-top maximum numbers at face value at all, and we can't take the worst period of time and say, well, we want to have 100% success because that bottom 5%, if the market were to actually follow the bottom 5% of a Monte Carlo simulation, we're probably talking about apocalyptic scenarios where the least of your worries is your retirement portfolio. Here's another thing you should know before we dig into the actual numbers. I have over 350,000 iterations of the simulated data, and then I take little snippets from one month to the next month for each year, and I chop them up. I'm only looking at simulated data as I'm making these percentage numbers, and the spreadsheet is just massive. You can see in the screenshot zoomed out to 15% how ridiculous the model is. I know that I probably could have had this programmed in a way that was more efficient, but my skills are in Excel. I could make it in Excel, even if it takes 2 hours to run one of the models. My whole point, though, is I ran the data a lot, and the actual results are going to asymptote to something that is statistically significant and not something that is a random outlier, something that didn't have enough iterations ran in the model to carry actual weight. So now let's talk about the focus of the study with the assumptions out of the way. What I wanted to do is I wanted to figure out if the 4% rule from the Trinity study still held. And if it didn't, what withdrawal rate is actually going to be applicable? And one of the problems is, in the Trinity study, I think they assumed 15 or 20 years for retirement. But retirement can last a lot longer, especially if you're someone in the FIRE community. You want to retire early, you want to take a nest egg and run it out for 60 or more years. The issue with the FIRE community's approach to the 4% rule is they take that as gospel as a perpetual safe withdrawal rate. While the Trinity study, because it had a year cap on it, didn't look at that safe withdrawal rate as something that was into perpetuity. It was a safe withdrawal rate that allowed you to take money out in a way that wasn't ultimately the most conservative that you could do, enjoy your retirement, and not run out of money within a given time frame. I think they also may have assumed in the Trinity study, it's been a while since I looked at it, but a certain mix of stocks and bonds for the given portfolio is either 30-70 or 50-50. Either way, the Trinity study basically slapped on a 4% as a safe withdrawal rate strategy, the amount of your initial nest egg that you can pull out in your retirement, and then continue to pull out, correcting for inflation throughout retirement. Now, because of the tight, narrow window that the Trinity study had for their safe withdrawal rate, I wanted to expand that and see how the risk of running out of money changes as we go for longer and longer retirements, given different portfolios and different withdrawal rates. With that, here are my results. If you're listening to the audio only, I'm going to invite you to look up the YouTube video or the Rumble video for this particular episode so that you can truly fully appreciate the visuals here. I'm going to be showing some fairly full tables of results from my study. And I'm not going to be able to walk through all of them, but I'll talk through them as best as I can so you can get an idea of what the results are and be thinking about them when you go and find the actual visual. The first table that I have here to share with you covers a 20-year retirement and a consistent withdrawal rate. So all the withdrawal rates that I have on the left side of the table are consistent. We don't mess with them. We don't have any financial guardrails. We're going to set it and forget it. This is for the person who wants to have a consistent buying power in retirement and isn't as concerned about modifying their withdrawal strategy in order to maximize spending or minimize risk. Along the top of the table, you'll see that I have a whole variety of portfolios. I used all bond and all stock mutual funds. I'm not going to say specifically which ones because I don't want these to be translated to being particular investment advice for those. But the first one here is a 100% bond index fund. The next column is going to be 80% bonds, 20% stocks. The third column is a 50-50 mix of stock index funds and bond index funds. The next is going to be 30% bonds, 70% stocks. The fifth column will be 10% bonds and 90% stocks, followed by the 100% stock index fund portfolio. After that, I have my own 401k in here because I thought, hey, I've got my 401k fairly aggressively invested. How would it do if I just didn't mess with it into retirement? I thought this would be especially interesting since Dave Ramsey recommends a fairly aggressive portfolio as you're in the accumulation stage, as you're saving up for retirement. And he says, oh, you don't have to change it into retirement. So if my portfolio reflects something that's really aggressive, like what Dave Ramsey would want, as I'm a relatively aggressive investor in the accumulation phase, what would it be like if I just left the portfolio unchanged and rolled into retirement with it? The last column was one that I added just out of sheer curiosity, and that is 70% my 401k and 30% in a bond index fund. Now, you mix bonds with stocks in order to try to reduce volatility and reduce sequence risk when it comes to withdrawal rate strategies. Now, let's look at the results here and what these numbers actually mean. The percentage represents how many iterations of the Monte Carlo simulation successfully made it to the end without you running out of money. So if at any point in one of the iterations you run out of money, it counts against the percentage. And because I'm looking at the worst 5% of the data as being unrealistic and unpractical, a percentage of 95% or greater, I consider to be a completely, in the context of this study, risk-free approach to retirement. Anything between 90 and 95% I consider to be a low risk but not free of risk portfolio in the context of the study. And anything below 80%, we're getting into risky territory that I personally cannot tolerate as a strategy. So the withdrawal rates, I started with a 2.8%, and almost everything here is 100%. The lowest percentage is going to be under my 401k at 98.1%. That's a win. We look at 3%, it's a similar story. If we go to 3.5% for the withdrawal strategy, well, now we're at 95.6% for my 401k. Still safe. Now, 3.75% is the tipping point. Everything is still safe. And in fact, the 100% bonds and the 80% bonds, 20% stocks have all been 100% numbers up to this point. Arguably overly conservative considering 95% is a win. The risk for my portfolio now says that I have a 94.3% chance of success. On the 4% row, I went ahead and bolded the results because everyone talks about the 4% rule. Let's see how it applies. Well, we get success everywhere except my 401k, which is at 92.7. And all stock portfolio is 97.7. And just for your reference, the 50-50 stock bond mix is now 99.7%. Well, we're relatively safe, and we follow this trend down to 5%. At a 5% withdrawal rate, we'll see that my 401k is the only one that's really dipped into some serious risk, whether it's mixed with bonds or not. I'm below 90%. If you're looking at the video, the remainder of the numbers below are no longer green, but they kind of fade off into oranges and reds. The bond index fund is actually the one that really starts to plummet. You go 5, 6, 7, 8% with the withdrawal rate. Going from 5%, where it's safe, to 6%, you go all the way down to a 56.0% chance of making it. Almost a coin flip. You go to a 7% withdrawal rate, and now you only have a 7.3% chance of making it. You just, in a 20-year span, can't make an all bond portfolio mix with a really high withdrawal rate in the context of the study. So how does this change when we get into a 30-year retirement? Well, what we've done is we've taken the withdrawal rate that's safe, anything with a 95% number and above, and we've raised it up quite a bit. In fact, in a 30-year span, my 401k doesn't stay above 95% at all. It's too aggressive. It's too volatile. The amount of wiggles in the Monte Carlo simulation result in me taking withdrawals out too often when the portfolio has dipped down low in a recession or just volatilely dropped unusually. So the best I can do at a 2.8% withdrawal rate is 93.6% chance of success. That's still good, but it's not a complete win. Now, if I mixed it with 30% bonds, my 401k, I could get it to 95.5% at 3% for the safe withdrawal rate. That's fine. How about the magical 4% safe withdrawal rate? The only two portfolios that still remained completely safe above 95% were the 80% bonds and the 50% bonds mixed with the stock index funds. Those are both very close to 95%, 96.1 and 95.2 respectively. As we drop into the higher safe withdrawal rates, nothing is safe, and we see that the bond-heavy portfolios suffer much, much more, just like they did in the 20-year. Now I'm going to skip ahead from the 40-year and just show you the 60-year results. Under the 60-year results, almost everything is orange and red. The only thing that stays above 95% is the 80-20, 80% bond, 20% stock portfolio, and the 50-50 portfolio again. And only if you have a withdrawal rate of 2.8%. Now, this is a very long retirement, 60 years. Let's say you live to 100, this is you retiring at age 40. So it's unlikely to happen, but it goes to show that the 4% rule is not perpetually a safe withdrawal rate. In fact, with the 100% bond index fund, you only have a 1% chance of making it at a 4% withdrawal rate. If you go 80-20, 80% bond, 20% stock, it's a coin flip. If you're 50-50, you have a 76.5% chance of making it in the study again. And if we look all the way up to the 100% stock index fund, the numbers are basically steady throughout the portfolios as they get more aggressive up to that point at 76.1. My 401k is 70.5% mixed with bonds at 73.2. Again, at the 4% withdrawal rate. One thing that you can see with the color coding and the gradients is that the bond index fund, just 100% as a portfolio on its own, is just not sustainable long-term without some sort of stocks. So if we're looking for something that is ultimately future-proof and can run indefinitely, we need to have some stocks in there. But we also see after a 50-50 mix for 60-year retirements in the study, the results start to become less and less favorable as we get more and more aggressive because we go from having a growth problem to having a sequence risk problem, introducing the risk. That's my interpretation of the data. So you're looking at this and you're like, great, well, what percentage would I even try to consider? Well, that's going to have to be something that you look at these risks, you look at other risks from other people who have done other studies, and you make an informed decision. And why does this even matter? You're not even close to retirement yet if you're in the accumulation phase. It matters because your safe withdrawal rate is going to help you dictate what your savings goal is. What number do you have to hit before you retire? If you know your withdrawal rate, you can take the desired income that you want in retirement, divide it by your annual withdrawal rate, and get what your nest egg needs to be, or your goal nest egg, if you will. Now, what I have here is the financial guardrail results for 20 years. That's what we're going to talk about next. And well, this table's kind of boring. The whole thing is green. Everything is above 95%. The lowest number is my 401k at 97%. And it's got an 8% withdrawal rate that completely succeeds. And what's covered here is the case where your nest egg falls below its initial buying value, accounting for inflation. And when that happens, we drop to a 3% safe withdrawal rate. If I were to go back to the consistent withdrawal rate strategy, what you'll see is the 3% row here is basically the same as the table where we have the buffer. Now, that's not to say that the higher withdrawal rates in this strategy are actually sustainable. If I scroll over to a table over here, what we can find is how often your actual withdrawal rates fall at the floor, which is the Fs in the F columns for each portfolio, your default, which would be equal to whatever row you're on the left, or the ceiling, which would be an 8% withdrawal rate. On the 100% bond index funds, we can see that almost all the time you're at the floor withdrawal rate. You're pulling out at 3%. And at the 8% withdrawal rate, only 5% of your retirement is going to see that withdrawal rate before you end up just defaulting to 3% for the rest of it. And that pattern is relatively consistent and becomes ever more favorable as we get more aggressive with the portfolio. You'll see that our odds of hitting the ceiling and having an 8% withdrawal rate are the absolute highest using the 401k. So we have a higher risk strategy if we keep everything really aggressive in retirement. But we also really radically increase the odds that we're, in the context of the study, able to withdraw 8% for up to, according to this table, 18.5% of the time, give or take. If you're just 100% stock index, you spend about 10% of your time at the ceiling at the 4% withdrawal rate. Over half the time, about half the time, you'll be at the default 4%. And then the remaining 36.2% of the time, you would have to be at the floor in order to keep things safe. While we're talking about the 20-year retirement results, I got one more table I want to show you. This particular table shows the average anticipated ending net worth of the retirement in the study for the different withdrawal rates and the different portfolios. Any of them that I mark in red with white text ends at a lower buying power than your starting nest egg. And I've corrected all these numbers so that they're inflation corrected. They show up in today's numbers, and today's numbers being the day you retire, the start of the study numbers. So anything below $1 million, I used $1 million as the baseline in the study. Anything below $1 million is below the initial buying power. So you know that the nest egg was trending down. I wouldn't ever personally, if I were learning from these results, engage with a portfolio mix that resulted in a nest egg that was below the initial buying power. That means I'm below the floor. It means that I was trending in an unsafe direction. And if I was confident that I was going to live for more than 20 years, but I was using the 20-year results to inform me for my retirement planning, the values that end, on average, below the floor, that's going to scare me. Now, the darker the green is, the higher the number, and you can see that the best results for maximizing the average ending nest egg value is to go with the most aggressive growth and the lowest withdrawal strategy. Now, I did do something very similar with the consistent withdrawal rates. This particular table here shows the exact same results without the floor being enacted. And if you toggle between the two on the video, you'll see that there's more red on the higher withdrawal rates. You're introducing more risk and a higher likelihood that your average ending nest egg value will be below your initial buying power. Now let's look at the 30-year results. This table shows the 30-year retirement results using the floor and the ceiling, using the financial guardrails. And again, everything is relatively safe except for anything involving my 401k. Now, the ultimate thing I'm seeing here is there's still a 90% chance of success almost irregardless of my default withdrawal rate, but it's not perfect. And if I just did a 100% stock index, I'm well above 96%, even if my default withdrawal rate is 8% in retirement. Now, remember, I'm not going to spend the whole time at 8%. I will default to 3 in the study quite a bit in order to get this kind of security. The 70-30 bond mix does allow me to have my 401k and then 30% bonds and get a winning number of 95% flat. Now, just to emphasize here, if I were to take that 100% stock index fund and I were to use that safe withdrawal rate of 8%, I'm going to spend just around 46% of the time pulling money out at 3%, 48.2% of the time pulling out money at 8%, and I'll only hit the ceiling 5.3% of the time, but the default is the ceiling for the bottom result. If I were at 4% withdrawal rate following the Trinity study, about 60% of the time, I'm able to pull money out at 4%. Only 1/3 of the time do I have to default to the lower withdrawal rate of 3%. You'll see that on my 401k, the numbers are relatively similar for how long you spend at the floor, but instead of having 59, 60% at the default withdrawal rate, given a 4% default, I'm only spending 59% of the time there, and the rest is getting bumped up to the ceiling. So there's a higher propensity for that ridiculous growth that enables you to raise your withdrawal rate when you're more aggressive. You just increase your risk of running out of money before your retirement's over by 5% in the context of the study. And since I showed you where we were for the average ending nest egg values for 20 years, I'm going to show them here for 30. For the 30-year retirement at a 3% safe withdrawal rate, the 401k ends with almost $6 million as an ending nest egg value. Meanwhile, all of the bond index fund portfolios, the 100% bond portfolios, they fall below $600,000 at the end of 30 years. And these are average numbers for the portfolios that actually survived. Now let's compare these to the results if we had a consistent withdrawal rate. You'll see that the more conservative portfolios with more bonds suffer more with the consistent withdrawal rate and the ending nest egg value. But the actual ending results for the 401k, instead of capping out at $6 million, are going to cap out at 6.8, almost 6.9 million for the 3% consistent withdrawal rate. And that's probably because we're not pulling money out at the ceiling. On the results below, because we have a financial guardrail at the top where we can increase our withdrawal rate, we're not maximizing how much we're leaving to the next generation at the end of our retirement. One funny thing I want to point out is that none of the 100% bond index funds for the safe withdrawal rate of 8% survived in order to get an average number. The average number for the ending nest egg value for the 7% was just $68, which tells me that it was probably like only one or two iterations in the thousands and thousands that ran through to get that number. And just the numbers are so incredibly low if you don't have a financial guardrail. I'm going to go back to that 30-year table. Looking back at the other table, you'll see that the 8% withdrawal rate for the bond index fund at least was around $500,000 for the average ending value of those that survived. And I think that just goes to show the testament and the power of how well the safe withdrawal rate buffer works, that bottom financial guardrail. But those are the study results. I also ran numbers for 40 and 50-year retirements, and I know that the 40-year retirement table is of great interest because there are a lot of retirements where you retire somewhere around 60, and you want to assume that you're going to make it to 100. And even if you don't, you think that's a pretty conservative age to consider for your lifespan. So the 40-year results are of great interest to many people. But I'm going to save those to be exclusive for my clients. So if you want to talk more about these numbers, you found these results interesting, well, feel free to reach out, schedule a consultation, and we can go over your situation and talk about how these numbers can help inform you as you develop your retirement strategy. Now, next week, I'm going to do a callback to some of these numbers, and I might pull up some of the results from 40 years. And the reason being is next week, we're talking about Dave Ramsey and his most dangerous retirement advice that he's ever given out on the radio. If you want to know what Dave Ramsey's most dangerous advice is for his listeners, you better subscribe or follow this podcast so you don't miss next week's. It's going to be a firecracker of an episode. Until then, until next Tuesday, budget bravely, and enjoy your hope-filled financial future.